Imagine this for a moment. You work hard. You save money. You invest with hope. And yet, somehow, the market takes more from you than it gives. You buy when everyone is excited. You sell when everyone is scared. You chase what's rising. You abandon what's falling. And at the end of the year, you look at your account and ask yourself one painful question. Why am I doing everything and still losing? Now here's the shocking truth that most people don't want to hear. The stock market doesn't destroy people's money. People destroy their own money. Not because they are stupid, not because they lack intelligence, but because they don't understand how investing actually works. And that is exactly why this book exists. The Intelligent Investor is not a book about beating the market. It is a book about surviving the market. And more importantly, about winning in the long run while everyone else burns out emotionally and financially. This book doesn't promise quick riches. It promises something far more powerful: peace of mind, rational thinking, and a lifetime of intelligent decisions. If you've ever felt fear when markets crash, if you've ever felt greed when prices rise, if you've ever made emotional money decisions and regretted them later, then stay with me until the end of this journey. Because by the time this video ends, you will never look at money, markets, or investing the same way again. Benjamin Graham was not a motivational speaker. He was not a YouTuber. He was not selling dreams. He was a quiet, disciplined thinker who lived through market crashes, economic depressions, and human panic. He experienced the Great Depression firsthand. He watched fortunes disappear overnight. He saw brilliant people lose everything because they trusted emotions instead of logic. And instead of blaming the market, he studied it. Benjamin Graham became known as the father of value investing. But more importantly, he became the teacher of the greatest investor who ever lived, Warren Buffett. Warren Buffett once said, "By far the best book on investing ever written is The Intelligent Investor." That alone should make you pause. This book was not written to impress Wall Street. It was written to protect ordinary people from making extraordinary mistakes. Jason Zweig later added modern commentary to help new generations understand Graham's wisdom in today's world of news, apps, and nonstop financial noise. And now, you are about to receive that wisdom, explained simply, deeply, and practically. Before we go any further, you must understand one truth that sits at the heart of this book. Investing is not about how smart you are. It is about how disciplined you are. You don't need high IQ. You don't need insider tips. You don't need to predict the future. What you need is control over your emotions. Most people believe investing is about numbers. But Graham shows us something shocking. Investing is a psychological game played with money. The biggest enemy is not inflation. It's not recession. It's not the market. The biggest enemy is you. Your fear, your greed, your impatience, your overconfidence. And unless you understand this from the very beginning, nothing else will work. One of the most dangerous mistakes people make is confusing speculation with investment. They look the same on the surface. Both involve stocks. Both involve money. Both involve risk. But inside, they are completely different. Speculation is when you buy something hoping someone else will pay more for it later. Investing, according to Graham, is very different. An investment operation is one that, after thorough analysis, promises safety of principal and an adequate return. Read that again. Safety first, profit second. If safety is missing, it is not investing. Most people speculate while believing they invest, and that illusion destroys them. They chase hot stocks. They follow trends. They listen to headlines. They panic during crashes. Graham doesn't say speculation is evil. He says it must be recognized and controlled. The danger comes when people speculate without knowing they are speculating. That is financial blindness. Now Graham introduces a character that may be the most important concept in this entire book. He calls him Mr. Market. Imagine this. You own a small business with a partner named Mr. Market. Every single day, Mr. Market comes to you and offers to either buy your share of the business or sell you his share. Some days, he's joyful and optimistic. He names a very high price. Other days, he's depressed and fearful. He offers a very low price. Here's the key point. Mr. Market doesn't know the true value of the business. He only reflects his emotions. And the market behaves exactly the same way. Prices don't move because value changes every day. They move because human emotions change every day. Fear pushes prices down. Greed pushes prices up. The intelligent investor does something most people never do. He doesn't follow Mr. Market's mood. He uses it. When prices fall irrationally, he buys. When prices rise irrationally, he becomes cautious. He never argues with the market. He never tries to predict it. He simply takes advantage of its emotional swings. Benjamin Graham makes something very clear. There is no one right way to invest. Instead, there are two types of investors, and both can succeed if they understand themselves. The first is the defensive investor. This person wants safety. They don't want stress. They don't want constant decisions. They prefer simple, diversified investments. They accept average returns in exchange for peace of mind. The second is the enterprising investor. This person is willing to work harder, study businesses, analyze financial statements, and search for undervalued opportunities. But Graham warns us, being enterprising requires time, discipline, emotional control, and humility. If you lack any of these, the defensive approach may actually outperform you. And this is a powerful lesson. More effort does not always mean better results. Here's where the book becomes uncomfortable. People don't fail because they don't know what to do. They fail because they don't do what they know. They buy high because everyone else is buying. They sell low because everyone else is selling. They abandon long-term plans for short-term emotions. Graham explains that the market is designed to test patience. It rewards those who wait and punishes those who react. This is why investing success has little to do with intelligence. It has everything to do with temperament. The ability to remain calm when others panic. The ability to remain cautious when others celebrate. At this stage, the book is not teaching you which stocks to buy. It is reshaping how you think. Because without the right mindset, no strategy will survive real-world pressure. You must accept, markets are unpredictable in the short term. Emotions drive prices more than logic. Losses are part of the journey. Patience is not optional. Once you accept these truths, you stop fighting reality. And when you stop fighting reality, you begin to win. Let me ask you something important. How many times have you made financial decisions based on fear? How many times have you followed the crowd? How many times have you acted quickly instead of wisely? This book is not judging you. It is freeing you. Because once you understand that mistakes are psychological, not intellectual, you can finally correct them. We are only at the beginning. In the next part, we will go deeper into market psychology, explore the defensive and enterprising investor in detail, and learn why trying to predict the market is a dangerous illusion. This journey will not make you rich overnight, but it can make you financially unshakable for a lifetime. Let's continue this journey exactly where we left off. By now, you understand something most people never truly grasp. The stock market is not a machine. It is a mirror of human emotions. And the investor who understands this truth gains an invisible advantage. Now Benjamin Graham takes us deeper into the daily behavior of markets, the illusion of prediction, and the danger of believing you are smarter than uncertainty itself. This is where many listeners begin to feel uncomfortable, because Graham starts dismantling popular beliefs. Human beings crave certainty. We want to know what will happen next. We want to feel in control. We want reassurance that our decisions are correct. So we turn on financial news. We read forecasts. We listen to experts predicting where the market will go tomorrow, next month, next year. Benjamin Graham calls this habit one of the most dangerous illusions in investing. Because the truth is simple and brutal. No one can consistently predict the market. Not analysts. Not economists. Not fund managers. Not even the most intelligent investors. If prediction worked, crashes wouldn't surprise people. Bubbles wouldn't exist. Everyone would be rich. But reality tells a different story. Markets move based on millions of variables: emotions, politics, psychology, fear, greed, surprises, most of which cannot be measured or controlled. Trying to predict short-term market movements is like trying to predict human moods. It feels logical until it fails. And it fails often. Graham doesn't say information is useless. He says too much information creates emotional noise. Financial news is designed to grab attention, not to protect your money. Headlines exaggerate fear during crashes. They amplify excitement during rallies. Market crashes. Stocks soar. Experts warn of collapse. Once-in-a-lifetime opportunity. But here's the hidden danger. By the time news reaches you, the market has already reacted. You are not early. You are late. News doesn't guide you. It pushes you emotionally. And emotional decisions are the opposite of intelligent investing. The intelligent investor learns to ignore the noise and focus on fundamentals. Now Graham returns to one of the most practical ideas in the book, the defensive investor. This investor accepts a simple truth. I don't want to beat the market. I want to survive it comfortably. There is no shame in this approach. In fact, Graham suggests that most people should be defensive investors, whether they admit it or not. The defensive investor values stability over thrill, consistency over excitement, long-term growth over quick gains. They don't chase trends. They don't panic during downturns. They don't react to daily price changes. Instead, they focus on broad diversification, owning a mix of quality stocks and bonds. This approach reduces risk, smooths emotional stress, and protects against major losses. Graham emphasizes that avoiding big mistakes is more important than chasing big wins. Because once you lose heavily, recovery becomes extremely difficult, both financially and psychologically. Modern culture glorifies extremes. We celebrate massive success stories. We ignore quiet consistency. But Graham flips this thinking upside down. He shows that average returns achieved consistently often outperform risky strategies over time. Why? Because avoiding disaster matters more than occasional brilliance. A defensive investor who earns steady returns year after year will often outperform a speculative investor who wins big once and then loses everything. This is not exciting advice, but it is powerful. And more importantly, it works. Now we turn to the second type, the enterprising investor. This investor wants to do more. They are willing to study business, analyze financial statements, search for undervalued companies. But Graham is very clear here. This path is not for everyone. Being enterprising is not about confidence. It's about discipline. You must be willing to study deeply, wait patiently, accept being wrong, ignore public opinion, control emotions. Most people believe they are enterprising investors, but most people are not. They confuse activity with intelligence. They confuse confidence with competence. Graham warns that overconfidence is more dangerous than ignorance. If you are not willing to do the hard work consistently, you are better off staying defensive. Here's a lesson that shocks many people. The more you trade, the more you lose. Not always immediately, but eventually. Frequent buying and selling increases costs. It increases emotional errors. It encourages impulsive decisions. Markets reward patience, not movement. The intelligent investor understands that doing nothing is often the most intelligent action. Waiting is not weakness. It is discipline. Let's talk about fear. Market crashes don't destroy wealth. Panic does. During downturns, prices fall not because businesses disappear overnight, but because fear spreads faster than logic. People sell to escape pain. They sell to feel safe. They sell because everyone else is selling. And they lock in losses permanently. Graham explains that declining prices are not the enemy of the intelligent investor. They are opportunities if you are emotionally prepared. But preparation happens before the crash, not during. You must expect downturns. Accept them. Plan for them. Because when fear arrives, thinking disappears. At this point, it becomes clear. This book is less about money and more about self-mastery. Can you stay calm when prices fall? Can you resist excitement when prices rise? Can you stick to your strategy when everyone tells you you're wrong? These questions determine success far more than technical knowledge. The margin of safety exists not because you are weak, but because reality is uncertain. Graham teaches that investment success does not require perfection. It requires protection. Most people think risk comes from volatility. Graham disagrees. He teaches that risk comes from paying too much for something. A wonderful business bought at a terrible price can be a disastrous investment. A boring business bought at a deeply discounted price can be extremely safe. The price you pay determines your margin of safety. When you pay too much, you leave no room for error. When you buy with a margin of safety, mistakes become survivable. This single idea has saved investors from ruin for decades. The market gives you prices. It does not give you value. Price is emotional. Value is fundamental. Price changes every day. Value changes slowly. The intelligent investor understands that price and value are often very different things. When price falls below value, opportunity appears. When price rises far above value, danger appears. The problem is that emotions push people to do the opposite. They buy when prices are high because excitement is high. They sell when prices are low because fear is high. Graham shows us that emotional comfort often leads to financial danger, and discomfort often leads to opportunity. Now let's talk about psychology. Human beings feel losses more intensely than gains. Losing $1,000 hurts more than gaining $1,000 feels good. This emotional imbalance causes destructive behavior. People panic sell to escape pain. They chase gains to feel pleasure. The intelligent investor acknowledges this emotional bias and refuses to be controlled by it. They plan in advance. They accept temporary losses. They focus on long-term value. This is not natural behavior. It is trained behavior. The intelligent investor trains the mind first. Money follows later. Imagine two investors. One watches prices every hour, feels anxious daily, buys and sells constantly. The other checks occasionally, stays invested, ignores noise. After 20 years, the calm investor often wins, not because they were smarter, but because they stayed rational. Right now, ask yourself honestly, do I enjoy excitement or peace? Do I want control or comfort? Do I want to act or to think? There is no right or wrong answer, but there is a right approach for who you are. Graham's genius is not forcing one method. It is helping you choose wisely and honestly. In the next part, we will uncover one of the most powerful ideas ever written about investing: the margin of safety. This single concept has protected investors for generations, and ignoring it has destroyed countless fortunes. We will also explore risk, inflation, and why protecting capital matters more than chasing profits. Up to this point, we've talked about emotions, psychology, discipline, and behavior. Now Benjamin Graham introduces the concept that holds all of intelligent investing together. If you understand this idea deeply, if you live by it patiently, it can protect you when markets collapse, when fear dominates, and when mistakes feel inevitable. This idea is called the margin of safety. Imagine you are crossing a bridge. Would you prefer a bridge that can carry exactly your weight, or one built strong enough to carry 10 times more? The intelligent person chooses the second bridge. That extra strength is the margin of safety. In investing, the margin of safety means buying assets at prices far below their true value. It is the buffer that protects you from errors in judgment, unexpected events, and emotional mistakes. Because here is the uncomfortable truth. You will be wrong sometimes. Your analysis will not be perfect. The future will surprise you. Most people define risk as price movement. Graham defines risk as permanent loss of capital. A stock falling temporarily is not risk. Selling at the bottom is. Volatility is the price of admission. Panic is optional. The intelligent investor understands that fluctuations are normal. They do not confuse movement with danger. Now Graham addresses a danger that many investors ignore: inflation. Inflation quietly erodes purchasing power. It doesn't crash markets. It doesn't make headlines. But over time, it destroys wealth. Holding cash feels safe. But safety is an illusion when inflation exists. The intelligent investor must balance safety with growth. This is why Graham encourages a balanced approach, especially for defensive investors, combining stocks and bonds. Because doing nothing is not always safe. People often confuse familiarity with safety. They believe bank accounts, bonds, or popular assets are always safe. Graham warns that perceived safety can be misleading. Safety comes from price, value, and discipline, not popularity. An overpriced safe asset can be extremely risky. An unpopular undervalued asset can be extremely safe. Again, everything returns to value. At this stage, Graham has quietly given us a mental framework. Accept uncertainty. Respect risk. Demand value. Control emotion. Think long-term. These principles protect you when logic disappears from the market. They help you act rationally when others cannot. Let's be honest. Most people don't fail because markets are cruel. They fail because they buy based on excitement, sell based on fear, trade too often, ignore value, abandon discipline. They want certainty in an uncertain world. Graham teaches acceptance instead of control. Imagine buying a solid business at a fair price. The market crashes. Prices fall 40%. If the business remains strong, nothing fundamental has changed. Only emotion has. The intelligent investor doesn't panic. They understand that price. The market crashes. Prices fall 40%. If the business remains strong, nothing fundamental has changed. Only emotion has. The intelligent investor doesn't panic. They understand that price fell, not value. And eventually, price follows value again. Ask yourself honestly, do I react emotionally to losses? Do I confuse price with value? Do I seek comfort instead of logic? These questions are uncomfortable, but freeing. Because awareness is the first step toward mastery. In the final part, we will bring everything together. We will connect these ideas to modern life, show how to apply them daily, and end with a powerful call to action that can reshape how you think about money forever. By now, you've learned something rare. Not a shortcut, not a trick, not a promise of quick wealth. You've learned a way of thinking. And that is what makes the intelligent investor timeless. Markets change. Technology evolves. Apps become faster. News becomes louder. But human emotions remain the same. Fear still whispers. Greed still shouts. Patience still feels uncomfortable. Discipline still feels boring. And that is why Benjamin Graham's wisdom still works. You might be thinking, this book was written long ago. Can it still work today? The answer is simple. Human behavior has not changed. People still chase trends. People still panic during crashes. People still confuse excitement with intelligence. Modern tools have changed the speed, not the psychology. And that means intelligent investing is more important than ever. Intelligent investing begins before you invest money. It begins with self-awareness. Ask yourself, am I seeking excitement or stability? Am I reacting to noise or focusing on value? Am I acting out of fear or reason? Then build your strategy accordingly. If you are a defensive investor, diversify widely. Invest consistency. Ignore short-term noise. Accept average returns proudly. If you are an enterprising investor, study deeply. Be patient relentlessly. Demand a margin of safety. Accept that you will be wrong sometimes. In both cases, discipline matters more than brilliance. Here's something powerful. The principles of the intelligent investor apply far beyond investing. They apply to life. Think about relationships. Chasing excitement often leads to instability. Patience leads to depth. Think about career choices. Quick wins feel good short-term. Long-term growth builds real security. Think about habits. Consistency beats intensity. Discipline beats motivation. Benjamin Graham didn't just write an investing book. He wrote a manual for rational living. Here's the hard truth. Most people will not apply these ideas. Not because they are difficult, but because they are uncomfortable. It is uncomfortable to be patient when others are excited. It is uncomfortable to be calm when others panic. It is uncomfortable to do nothing when others act. But discomfort is the price of wisdom, and comfort is often the price of regret. Intelligent investing does not feel powerful in the moment. It feels slow. It feels boring. It feels lonely. But over time, it becomes unstoppable. Small, rational decisions compound. Emotional mistakes disappear. Confidence grows quietly. And one day, you realize something important. You are no longer reacting. You are choosing. Imagine two people standing at the edge of the market. One chases every movement. One stands calmly. Years pass. The market rises. The market falls. Fear comes. Excitement comes. In the end, the calm investor walks away with more. Not just money, but peace. Let this sink in. You do not need to outsmart the market. You do not need to predict the future. You do not need to be perfect. You need discipline. You need patience. You need a margin of safety. You need emotional control. That is what makes an intelligent investor. Pause. Think about your past decisions. Think about your past decisions. Think about your emotions. Think about what you now understand. This awareness alone is valuable. Knowledge changes nothing without action. So start small. Review your habits. Reduce emotional decisions. Focus on long-term value. Respect uncertainty. And remember, the market is there to serve you, not to guide you. If this audiobook helped you see investing differently, take a moment to support the universe of book. Like this video, it helps this wisdom reach more minds. Subscribe to the channel for more deep, life-changing books. And comment below. Backhand index pointing right, what was the most powerful idea you learned from this book? Your reflection might inspire someone else. Benjamin Graham once showed the world that success is not loud. It is calm. It is patient. It is disciplined. And now, that wisdom is yours. Thank you for listening. Stay rational. Stay patient. And invest intelligently.